Shall we? Now let us go ahead and take an example on IND AS 102 share-based payment accounting, and also IND AS number 33 on calculation of basic and diluted EPS. It is a combination of IND AS 102 and 33, that's accounting for share-based payment transaction and earnings per share. So here we go with the question. Yes, ma'am.
The following particulars in respect of stock options granted by a company are available. Number of shares 4 lakh. Grant date April 1, 2008. Number of employees covered 600. Number of options granted per employee 100. Vesting condition continuous employment for 3 years. Nominal value per share rupees 10.
Okay.
Exercise price per share rupees 45. Vesting date 31st March 2011.
That is at the end of third year.
Exercise date 31st May 2012.
So that means the employees will have to buy the shares by May 2012. Okay, should be March 2012. Okay, that's a printing mistake in the question itself. Next.
Fair value of option per share on grant date is 15 rupees.
Okay.
Position on 31st March 2009. Number of employees expected to satisfy the service condition is 540.
What is the meaning? Out of 600 employees to whom the options have been granted, only 540 employees will be in employment on 31/3/2011 in 3 years' time. Next.
And then number of employees left 15.
The actual number of employees left is 15. Next.
Profit before amortization of ESOP cost 11.9 lakh.
This amount is given for you to calculate the basic and diluted EPS. 11 lakh and 90,000 is a profit for the year before debiting the employee compensation or employee benefit expense arising from the share-based payment transaction. Next.
Yes. Fair value per share rupees 60.
The fair value, not the value of the option. It's a fair value of a
share.
Is rupees 60. Your company shares are trading at rupees 60 at the end of first year. Next.
Position on 31st March 2010.
Okay.
Number of employees expected to satisfy service condition 552.
552 employees will satisfy the vesting condition.
Number of employees left 20.
20 employees are left in year 2. Already 15 left in the first year, another 20 left in the second year. Then
profit before amortization of ESOP cost 12.62 lakh.
Okay, that is rupees 12 lakh and 62,000. Next.
Fair value per share 66.
It is 66. Next.
Position on 31st March 2011. Number of employees left 11.
11.
Number of employees entitled to exercise the option 544.
554. 554. Nothing but from 600 if you subtract, that is 15, 20 and 11, you will get 554 employees would have satisfied the vesting condition by the end of year 3. Then
profit before amortization of ESOP cost is 13.79 lakh.
Okay.
Then fair value per share is 72 rupees.
72 rupees.
Position on 31st May 2012.
31st March 2012.
The number of employees exercising the option is 550.
It is 550 employees exercise the option.
Number of employees not exercising the option is 4.
4 employees are left, or they decided not to exercise the option. Next.
Show employee compensation account, ESOP outstanding account for 2008-9 to 11-12, and also compute the basic and diluted EPS for the years 8-9 to 10-11.
In your steady mat parlance language, the employee compensation expense nothing but the employee benefit expense.
Okay.
And in your steady mat parlance, the phrase share-based payment reserve account is nothing but employees, stock options, outstanding account. In fact, the standard IND AS 102 uses a phrase share option outstanding account. Instead of share based payment reserve. Is that fine?
Yes, sir.
So please remember, that is, you can either call that as what? The share or stock options outstanding account. What is the other name? Share based payment reserve. Is that clear?
Yes, sir.
Now guys, if you are comfortable, it is better use your study mat parlance. What is that? Employee benefit expense account and share based payment reserve. But trust me, IND AS 102 uses the phrase share options outstanding account and not a share based payment reserve. Is that clear?
Yes, sir.
So you follow your study mat and use these phrases. Now let us go ahead and take on the solution.
Yes, sir.
What I will do first, I'll go through the 3 working notes to find the employee benefit expense each of the 3 years. Then I will run through the employee benefit or compensation expense account and the share options outstanding account. Is that fine?
Yes, sir.
Now let's go ahead and take on the solution. Refer to the first working note.
Yes, sir. 1 minute.
Yes. Okay guys, refer to working note number 1, 2 and 3. Let us refer to working note 1. Expense for the first year, 8, 9. Now we know that 540 employees will satisfy the vesting condition. That is the expectation, right? And that into 100 options each. Works out to 54,000 options will vest. And that into the options fair value given as rupees 15. We know it's a 3-year vesting period, right? So the expense for the first year will be, it is 540 employees into 100 options each into rupees 15, the fair value of one option. That into 1 divided by 3. How much you get?
We get the fair value is 8,10,000 and that divided by 3 is 2,70,000.
2,70,000 is a expense to be recognized in the first year. And let's go to the second year. In the second year, we know 552 employees are expected to satisfy the vesting condition. And that into 100 options each gives 55,200. That into 15 rupees a fair value per option. And that into 2 divided by 3 will be the cumulative amount of expense to be recognized by the end of year 2. Out of 3 years, 2 years over, right?
Yes.
So into 2 by 3. Now tell me how much you get. 55,200 into 15 rupees.
8,28,000.
That into 2 by 3. 8 lakh?
5,52,000.
That is the total amount. 5 lakh and
52,000.
is a total amount to be recognized as an expense by the end of second year. But out of 5 lakh and 52,000 rupees, 2 lakh and 70,000 has been recognized as an expense in the first year. So how much more? 2 lakh
2,82,000.
is an expense for the second year. Now third year, no issues at all. We know 554 employees satisfy the vesting condition, right? So I take 554 employees into 100 options each, that into rupees 15. It is the total amount, or you can do even into 3 by 3. It's up to you. What is the total amount?
It is 8,31,000.
Out of 8,31,000 to be expensed in 3 years, we have already recognized 5,52,000 the first 2 years. Now what is 8,31,000 minus 5,52,000?
2,79,000.
Is a expense to be booked for the third year. Is that clear?
Yes, sir.
Now we shall go ahead and take on the employee compensation expense account. If you want, you stick on to your study mat language. What is that? Employee benefit expense account. Is that fine? It's all the same.
Yes, sir.
What is the entry? It is employee compensation expense account debit to employee stock or share options outstanding account. Again, what is the study mat language? Share based payment reserve. But I am sticking on to the language given in the standard, okay? So it is going to be, just see the entry. In your employee compensation expense account on the debit side, it's going to be to Employee stock option outstanding, ESOP outstanding account will be 2,70,000, and you all know the expense will be transferred to profit and loss account. I'm not going to give the entry for that, okay? You know that. And then second year also same thing, 2,82,000 expensed. Third year 2,79,000 expensed. Done. Then I'll go to the next account. What is that? The share options outstanding account. In your study mat parlance, share based payment reserve. The first 3 years, no big deal, right? On the credit side, by employee expense and 2 balance carried down. It accumulates.
Yeah.
Second year also same way. Third year fine. Now just see the fourth year. So I'm not discussing each and everything because it's already there on the screen, right?
Yes.
And I am discussing this example for your May 2nd Diwali, right? Okay. So please remember, go to the fourth year, 2011-12. What is the buy balance brought down?
8,31,000.
You know this 8,31,000, nothing but 554 employees are still there into 100 options each. In all 55,400 options vested into 15 rupees will be equal to 8,31,000, nothing but the amount that has been collected as consideration for the options granted through their service. They're getting money, right? I have that in mind, 8,31,000. Just see the debit side. Sir, what is the amount to be transferred to general reserve? In fact, that is what the standard says. Whereas in a study mat, they transfer this amount to retained earnings. Remember, the 550 for employees, only 550 exercise their option. 4 employees did not. Right?
Yes, sir.
Now, what is 4 employees into 100 options? 400 options forfeited into 15 rupees you already collected from them. How much you get? 6,000 rupees. That will be transferred to general reserve. That is what is given in the standard in para 23.
Yes.
Of the standard. But in your study mat, they are transferred to retained earnings, but nothing wrong. Whether you transferred to general reserve or retained earnings, it doesn't matter because anyway both are free reserves available for dividends, right? Not an issue. Therefore, to general reserve, how much?
6,000.
The amount is 6,000. Now let me come to this. You know, that means 550 employees exercise their option, right? What is 550 into 100 options each? In all, 55,000 options are exercised. So the employees will pay the exercise price to the company. So a company receives that money. The entry can be bank account debit to share-based payment reserve account. Nothing with this outstanding account. By bank. You find by bank?
Yes, sir.
Which is 55,000 into 45 rupees collected. That amount is taken. Now people have a doubt. So what is the amount to be taken to share capital? Very simple. 55,000 shares are bought into face value rupees 10 each. What is the amount? 5,50,000 share capital. Now people have a doubt. So what is the amount to be taken to share premium? No big deal. You can either have it as a balancing figure, but some students are there, no sir, I want to know sir, how you get that premium. Very simple. Now tell me, there's a note given below. How much have we collected from the employees on every share? 45 rupees in cash. And how much we got from them through service? 15 rupees. In all, 60 rupees we collected. Of that, 10 rupee goes to share capital. The balance of 50 rupees taken to securities premium. Very simple. So 55,000 shares allotted into rupees 50 will be the amount transferred to securities premium account.
27,50,000.
That is all account tallied. Done. Now this alone can be an examination question, but I am very sure they are going to combine IND AS 102 and 33, and they will see how well you understood IND AS 33 as well. Okay. Now we shall go ahead and take on a calculation of basic and diluted EPS. Now computation of basic EPS is a child's play, right? Very simple. Now please refer to the table given out there, particulars, years 2008-9 9, 10 and 10, 11. The profits are given are rupees how much? 11 lakh? 90,000. Rupees are 12 lakh?
62,000.
And year 3?
13 lakh 79,000.
But remember, these are profits before subtracting or before debiting the employee compensation expense relating to the share-based payment transaction, right?
Yes, sir.
Now, from these numbers, you got to subtract rupees 2 lakh and 70,000 year 1, 270. And then you got to subtract 2 lakh and 82,000. And third year?
2 lakh 79,000.
Now, have they given rupees in thousands?
Yes.
It is 1,190 minus 270. What is the amount?
920.
And then rupees 1,262 minus 282.
980.
And then third year profits?
1,379
Minus?
minus 279, 1,100.
And these are the profits available to shareholders, that is holders of ordinary shares. But here one thing missing. What is that? The deferred tax impact not taken. Okay.
Yes.
So because this employee share-based payment will give rise to a deferred tax asset, but that has been ignored. So ignoring the deferred tax impact, these are the profit numbers. Now divide these profit numbers by the number of shares outstanding through the year, 400,000 shares, right? And you get the earnings per share basic. How much is it for year 1? Okay.
2.45.
Okay.
2.75.
Now these are the basic earnings per share for the 3 years 8, 9, 9, 10 and 10, 11. Now how do you go about calculating diluted EPS? For that you have to calculate now what is a potential ordinary shares that will cause a dilution when it comes to share options, right?
Yes, sir.
So that is the crux over here. How do you calculate? Now you would have done this concept in IND AS 33 anyway regarding or relating to share options. But how do you use that knowledge when it comes to ESOPs? What is either employee stock option plans? Now refer to the table 2008, 9, 9, 10 and 10, 11. What is the first line?
Actual number of employees.
That is the actual number of employees at the end of each year is 585.
565.
That is 600 minus 15 left, 585. And for year 2, it is 600 minus 15 and 20. So 565. Third year, no problem, it will be 554 employees, right? And then the next line.
Option granted per employee.
Very simple, 100 options each. That is 58,000.
500
will be the total options.
500
and then
55,400.
that means what? In case a employee is allowed to exercise their option end of first year itself, that can't happen. They have to work for how many years? 3 years. What if the options are exercised at the end of first year by those 585 employees? Then the company has to issue 58,500 shares. What if? Okay. And 565 into 100 is 56,500. And last year 55,400. That is the number of shares the employees will get or the company has to issue in case options are exercised end of year 1, end of year 2, end of year 3. Then
exercise unamortized ESOP cost per option.
What is that, sir? Very simple. Remember the 15 rupees is supposed to be the fair value of the option granted.
Yes, sir.
That 15 is collected by the company from the employees across 3 years. Now what happens end of first year, 1/3 of 15 would have been already collected from the employees through their service. What is the balance amount? 10 rupees not yet collected. When you come to year 2, 2/3 would have been collected out of 15 rupees, leaving a balance of 5 rupees not yet collected. And end of year 3, all the 15 would have been collected. Always understand, nothing is free. The only thing, the options fair value 15 rupees is collected from the employees through their service. They don't pay this option premium. Is that fine?
Yes.
Okay. Next.
Next is the exercise price 45 rupees.
That is the price I have to pay for the shares bought. 45 rupees and all the 3 years. Next.
Then expected exercise price to be received.
Nothing but it is 58,500 into
45.
45. 56,500 into 45. And 55,000
400
into 45. But remember, when the employees come and ask me at the end of first year, sir, I want the shares. Then I will tell them as a company, I don't mind giving you. But you have to pay not only 45, also pay another 10 rupees. Why? Either you work for another 2 years and get the shares at 45, or you pay 45 for the share plus another 10 rupees. What you are supposed to work for the next 2 years, right? You pay that amount in advance. Is that fine? Just see the next line. What is that?
Unamortized ESOP cost.
Nothing but 58,500 shares if allotted on that day. The company will not only collect 45, they will also collect how much?
Another 10.
10 rupees. That means in all, the company will collect 55 rupees from the shareholder, from the employees, for the shares given to them if the options are exercised end of year 1. That is the meaning. That is why 58,500 into 10, and for year 2, 56,500 into 5. Last year nil anyway. They already worked for all the 3 years. The next line.
The total proceeds.
That means that will be the total amount collected by the company, adding both 45 plus 10, right?
55, yes.
In all 55 rupees into 58,500. How much you get?
It's 32,17,500.
They're adding the two numbers. For second year?
Second year, it is 28,25,000.
Then third year?
24,93,000.
Now check this. If you were to allot, what is the total proceeds? 32 lakh?
17,500.
All this imagination, okay. If this amount is collected from the employees, 45 plus 10 collected, if for the same amount of money, had the company issued shares at fair value, what is the fair value per share end of year 1? Is given as rupees 60. So, yes. Second year, how much? 60? 6. Third year?
72.
What are you going to do? You can divide and find out. What is 32 lakh? How much?
17,500.
Divided by rupees 60.
53,625 shares.
That means what? For the same amount of money, had your company issued shares at full market price, would have issued only 53,000?
625 shares.
Exactly. But how many shares will allotted? 58?
500.
The difference is like shares issued for no consideration. That will cause dilution. What is the difference? 4,000?
875.
For year 1. For the next year, divide the total proceeds by 66. How many shares you get?
42,803 shares.
Minus that from 56,500, the difference.
13,697 shares.
You can say those are shares issued for no consideration. And then for year 3, it is divide the proceeds by
72.
72.
We get 34,625.
Very good. And then
minus 55,400, we get 20,775 potentially.
That is all. These are the potential ordinary shares that will cause dilution, which are issued for no consideration. You get it? Now there is a shortcut to find these numbers. People can take the calculator, okay? Just listen carefully. You can do this if you want to. Now tell me, for the first year, how many shares will be allotted? 58,500. If all the 585 employees decide to buy the shares, right, at the end of first year, 58,500. Now tell me how much will be collected from the employees? 45 rupees plus another 10 rupees in cash. In all, 55. But what is the fair value per share?
40.
60.
Sorry, 60.
60. That means what? That means a company will allot 60 rupees worth of shares for how much? For 55 rupees. What is the dilution discount? 5 rupees discount given, right? On every share. Take a calculator. It is 58,500 into 5. The discount divided by 60.
92,500 by
into
60.
5 by 60. If you do that,
4,875.
you will get the potential ordinary shares directly.
Yes.
Now look for second year. Second year, tell me, we want to collect 45 rupees from the share from the employees,
Plus
another 5 rupees for early exercise. In all, 50 rupees is collected, proceeds per share. But what is the fair value per share?
66.
That means what? There is a discount of 16 rupees. Now what you can do, take a calculator, 56,500 shares outstanding, right?
Yes, sir.
That into 1616 divided by 66.
You
will get
13,697.
You will get that number directly. Understood?
Yes, sir.
So those are shares issued for no consideration. That will cause dilution. Is that clear?
Yes, sir.
For the third year, no problem. Compare 45 rupees with 72.
Yes.
They'll pay 45, 72 fair value. That means there's a discount of rupees 27. So take 55,400 shares into 27 rupees upon 72 will give you the
20,775.
number of shares. Now the last step is very simple, finding diluted EPS. What you should do? Take the profit computed earlier, another table. How much for the first year?
9,20,000,
Second year.
9,80,000 and 11 lakh.
And number of shares will be, take the 4 lakh what is taken for basic EPS plus another 4,000.
875, 13,697 and 20,775.
When you divide the profit by number of shares, you get the EPS. How much?
Diluted EPS 2.27.
You saw which is less than 2.3 basic. Second year.
2.37.
Earlier it was I think 2 point.
It's
The basic
2.45.
has come down to 2.37.
37.
And for year 3,
It is earlier it was 2.75, now 2.61.
that is all, guys. So that is how you incorporate, the share based payment arrangement in your calculation of diluted EPS. So here the crux is, how do you calculate the diluted EPS? It's a very good sum, combining IND AS 102 on share based payments and IND AS 33 EPS. Very important from examination standpoint. Learn this really well. Good luck.
Yes.